You're listening to the Sage Planning Solutions Podcast. Securities and advisory services offered through Catteray Grant & Company Incorporated, a registered investment advisor and member FINRA SIPC. Catteray Grant and Sage Planning Solutions are separate and unaffiliated entities. The information provided here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Any opinions or forecasts contained herein reflect the subjective judgments and assumptions of the authors only and do not necessarily reflect the views of Catteray Grant & Company Incorporated. Investing is subject to risks including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. This information is not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Neither Catteray Grant & Company Incorporated nor its registered representatives or employees provide tax or legal services. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice.
Welcome to the Sage Planning Solutions Podcast. I'm your host, Dominick, and I'm joined today by my two co-hosts, Patrick Bennett and Brad Marshall. In today's episode, we'll be speaking about the investment policy statement, also known as the IPS, which you've heard us mention quite frequently in previous episodes, what it is, its benefits, and how to use it. So the question is, what is an investment policy statement? It's a working document that outlines the main goals of an investor's investment plan and lays out the framework to help reach those goals. So this is extremely important because the investment goals outline the broad financial aims for the investor, and the investment objectives define the specific actions required to reach those goals. So gentlemen, in your experience working with an investment policy statement, how have you used it as part of your business and your client experience?
Hey, Dom, this is Pat. We've used an investment policy statement successfully and unsuccessfully. And I'll tell you first how we used it unsuccessfully. We didn't stick to it. We had a foundation that had money for, it was a higher education foundation. And they basically said, here's our goals with the money. Here's what we're not willing to risk. Here's what we don't want to lose. And here's the upside that we're willing to accept in order not to, have that downside risk. And that was fine. We wrote it out, we said it. And then anytime that you have a board, there's always one turkey on there who's going to go, why aren't we buying this? Why aren't we buying that? And it's usually a guy who has a pretty high opinion of himself, and he tries to equate lucky picks in the stock market to his overall investor acumen. And when you get guys like this on the board, they start running their mouth about how we should break out of our investment policy statement's previous goals and start investing in new things. So this is the tale as old as time. Nowadays, we call it FOMO. And so what he did is he got the board to basically pull money out of something that was about as secure as it gets, right? It was 180-day, 1-year T-bills. And at that time, they were probably making a little bit better than 5%. And he wanted to get it into, I'm not going to get into what he wanted to put it in, but it was something that was sort of a bubble. It was sort of a hot dot, and he was willing to chase it. Cutting to the chase, they lost about 20% on that. And then when it fell back to me of, hold on, why did this happen? I can't, we're really sort of shocked here. It's sort of like, hey guys, here's the good, the bad, and the ugly, right? There's no free lunch. If you want to invest in this hot dot type stuff, you're going to have to take the downside. And that was settled, away privately. But that's how it was used poorly. Here's how it's been used in my experience successfully, is that if you start off with your client and you have some real honest talks, don't tell us about the flowers. Let's get into the weeds. Don't just tell us about all the things you've done successfully, but let's talk about some things that you've done that have hurt, right? And ultimately, I think that's what most of our clients are trying to avoid is, man, if I talk to these to this company, to Sage, are they going to hurt me? Are they going to hurt me, in poor performance? Are they going to lose me money? Are they going to charge me a lot of money? Are they trustworthy? There's all these things that are running through someone's subconscious, or maybe it's coming straight out of their mouth. So those are things that, we're worried about. But when we avoid the flowers and get into the weeds, what we can do is we can have a real honest conversation about what does money mean to you? And Dom, I've told you about this before. So I'm talking to one client, and he said, when I was a kid, my dad owned a restaurant. I said, wow, that's great. He says, no, it wasn't great at all, because all of the employees were stealing from us. My sister and I had to leave school, and we had to go work in that restaurant, and we didn't get paid. We didn't get to go to school. We had to work in this restaurant, and everything was always so tight, right? So that was a major, well, I'm going to call it a high water mark in his past in terms of what does money mean to me. Another one says, I grew up over in this area of the country, and man, we went goose hunting all the time. And in my head, I thought, oh, wow, what a neat family tradition you guys get to do. And he says, no, it wasn't great. We hunted that stuff because we had to eat, and we all hated goose, but it was around. Again, another demarcation point of this is what money means to me. And the three of us have shared our sort of stories, but those are all great. But until you could sort of put that down, and what we're trying to do is chronicle some way of an understanding of what are your core values as it comes to money. Because what we get caught up in is when the market's flying off the handle, and this is probably going to date us a year from now, but where's Bitcoin today, Dom? A little around 78K?
About 67,000.
So what if somebody says, hey, this Bitcoin thing, why am I not a part of that? And they buy at the top of the market. And if it goes back down to $47,000, what did we do? We transgressed on our own set of instructions, which is these are the type of people that we are. And this is what we want our investment portfolio to look like. So there's FOMO on one side. And on the other side, it's the market's going down. What should we do? Well, in our investment policy statement, we are long-term investors that does not believe in getting in and out of the market. We believe that the American stock market is going to be an ongoing concern. And even when things get bad, we should stay the course and even be thinking about being able to put more money into the market if things are on sale.
One of the main things it does is articulates an investor's long-term goals, right? It also talks about and addresses risk tolerance. What's the appetite for risk? In a bull market, our appetite for risk is infinitely high. In a bear market, it's zero. So there's a floor for most, not every investor, but most investors have a floor of zero risk when a bear market hits. And it overall is a roadmap for everyone involved, and it helps us keep focused throughout all the different types of market cycles. So the investment policy, those are some of the benefits of them. Now, it keeps us on track to make sure that during a bull market, we're not chasing performance. Like you mentioned, Bitcoin. It's an asset class. We have some that are through an ETF now, regulated, which is what people have been waiting for. And now the conversations are, should I have it? If so, how much should I have? It's an alternative asset class, which again, you guys heard me say a lot of times, alts are the future. And depending on how much and what type of alts you're putting into your portfolio, they can benefit you in terms of managing risk. Bitcoin, on the other hand, the standard deviation of Bitcoin is extraordinary. So you say from 67,000 down to 47,000, that would be a normal range for a Bitcoin, but for the equity markets or individual stocks, not so much. The reason why the investment policy statement, in my opinion, is very important is because it keeps us focused on the long-term goals and not the short-term gyrations of the market, whether they be up or down. What about you, Brad? How have you implemented the investment policy statement with your clients?
Well, it's important to remember it's a guide, right? We do the heavy lifting. We're not going to send you home with a bunch of homework, but it's important to lay a foundation because when the market's up, everybody wants more money. When the market's down, everybody wants more protection. And actually right now is a good example, because these AI stocks are skyrocketing, and are they going to keep going up? Probably for a little bit, but at some point they're going to come crashing down. They're going to, what goes up must come down. So it's really important to have that foundation so that when people get greedy, and it always happens, they get greedy and fearful. So when people get greedy, it's important to look at it. And it's not there for us to say, I told you so, or, what to do and what not to do. It's important to remind people, hey, look, you got enough to live the rest of your life. Do we need to get greedy at the top of the market? When the market's going down, hey, look, you're still saving for retirement. You need higher returns. It's important to have the IPS when people are getting overly greedy and overly fearful to remind them. And actually, it's a great conversation for us as advisors with our clients as well, because you just look historically when things are skyrocketing, it always comes down. And then when things are dropping, it always goes back up. And actually, if sometimes people want to add more because of FOMO and something's crypto and AI stocks are skyrocketing, it's the wrong time to start jumping on. Now, that's not to say that we're not going to buy those things when the market corrects, because if you know the crypto sector theoretically and historically, we're due for a correction, which is the perfect time to start buying things. But as we all know, and clients know, they start watching the news and they call us and say, hey, what's up with this? What's up with AI? Are we buying NVIDIA? What's going on with crypto? We should be in there. And so the IPS is important to remind clients. It's a great tool, but it's also just a guide, right? It's not there for us to tell them yes or no, but it's a foundation to keep people thinking soundly and rationally when they get emotional about their portfolios.
It keeps everybody on the same side of the table too. And it's very transparent.
Perfect.
Essentially, a client, you can consider them, they're the CEO of their money. We can act as a CFO and give them a bunch of great ideas based on what they're telling us. But at the end of the day, they're the ones that got to pull the trigger and make sure that they're comfortable with this. And it's a working document. So it's not set in stone, set it and forget it, which is the worst thing you can do. It's something during our meetings, we don't call them reviews because I don't want to review what already happened. I want to plan for what's coming ahead. So I don't call them review meetings. I call them strategy meetings based on where the current market is, the economy is, and where policy is going. So I look at it as a strategy meeting, and this is something we review during those meetings. Has there been any change to your objectives, your goals, your appetite for risk? And it's up to the client to articulate that to us because we're already asked the questions. I'm going to say most people in the financial services industry have your best interest at heart, right? We're highly regulated interest. The more information that a client can share with us, the better plan we can develop for them. And as Brad said, it's a foundation, but an investment policy statement is not. It is not a financial plan. You can't build a good financial plan without having a well thought out investment policy statement. They go hand in hand. The financial plan is going to cover budgeting, savings goals, debt management, insurance needs, retirement planning, and estate planning, where your investment policy statement is going to cover asset allocation, risk tolerance, investment strategy, and your overall investment.
I think I could even simplify it for anybody who's thinking, wow, this sounds like a lot of stuff going on. I would say this is going to be very much a reflection of who you are as a person. And let's take the guy and gal that have owned a home for years and they put $50,000 down, which they can't believe they put that much down as a down payment. And they bought a $500,000 house. You know, like this is back, not even 500. Let's push it back. They put 20 grand down and they bought a $300,000 house.
That might have something to do with it.
I think that I could simplify this even further in that this is a statement that this is your family culture. This is who we are as a family, and this is who we are. And if you say, hey, listen, we're into boats and we're into traveling and we're into a bunch of things that are going to cost an awful lot of money, and we're willing for those expenses to supersede our investing, then that's fine, as long as we know about it. And that's the way it's going to be dealt with. And most of our clients are fiscally pretty conservative. They're savers. They realize that their number one retirement asset is their income that they're making today. They are believers in owning the same home for 20, 30, 40 years. They don't believe in flipping. They don't believe in chasing the hot dot. They don't believe in trying to get cute about stuff and capture upside in new markets. And there's a lot of people who can do that. Most of the people that do it, they'll do it once and you may never hear from them again. The people who try it and never tell you the outcome, it's usually because it's too embarrassing and they don't want to admit the truth. And we understand that. Money's a very emotional subject, but when you're doing this is basically a statement of who we are as people. You know, let's be honest here. People rarely change. If you are a saver and you've always been a saver, and some financial professional comes up and says, hey, I need you to throw a bunch of money into the stock market, that's going to make they're going to cringe. But if you say, hey, listen, I'm okay with making 6.5% if I know that I'm not going to have emotional blowback trying to deal with all this stuff. One of my mentors used to call it the gastronomic gauge. Hey, when markets are going down, usually this little thing activates in me and I know it's probably time to start buying. Firstly, when markets are way too high, you kind of start to cringe, right? And so these are the things that sort of intuitively tell you what the right thing is to do. As a lot of us know in this industry, we've been around long enough, the easy thing to do is almost always the wrong thing to do. Take me to cash. I can't take it anymore. And then the next thing you know is the market recovers and it's gone and you'll never find a place to get back in. The hard thing to do is almost always the right thing to do, which is, hey, I know this is, you're going to want to kick me in the shins for saying this, but stay the course. You own a bunch of things that have great balance sheets that are going to come back when this market turns around. You've been through many of these already. Hang in there. You could do it. But no one really wants to hear that because at 2:00 in the morning when mama kicks papa and says, I don't like these guys. They didn't do a good job setting my expectation level. This is too much for me. Guess what? We're getting a call the next day from Papa and he's going to say, guys, I'm sorry, it didn't work out. And a lot of that's because we didn't push them to ask the questions that informed an investment policy. And so there's a disconnect. we had them invested more aggressively than they should have been, or conversely, we didn't understand very well and we had them invested too conservatively for what they probably should have done. Brad, you nailed it. Somebody who's 65 today, 30 years ago, the book was so much different than it is now. Now it's like, hey, you might live for another 20, 25, 30 years. You can't own fixed income to the extent of maybe where you were hoping that you could. You're going to have to be exposed to risk assets. Dom mentioned alts. That's going to be a huge part of the future. But it all comes down to honest conversations.
Yeah, I'll give you a couple of examples that I think people will resonate with. One, think about now. I mean, the market has skyrocketed ever since the Great Recession, really. I mean, we've had some corrections. 2022 was a significant correction, but the market's done fairly well. We've got Waltons and Gates and Buffett even trimming their gains, selling some stocks, going to cash. So what's that tell you? The majors are buy low and sell high. Selling high is a critical one. And when the market's going straight up like it is, and we have so many clients, especially in Silicon Valley, who've made fortunes in their company stocks, when we go to them and say, hey, look, you've got a big chunk of your net worth invested in this stock. And they go, well, yeah, I'm never selling that. The investment policy statement helps us say, right, however, if we can trim this or use some option strategies that will preserve the gains that you've made when, not if, but when we have a correction, then it's really helpful. And clients are always very appreciative when it works, right? And so the other one, I'll just use an example where I should have had an investment policy statement. I didn't. The Great Recession, for those of you who lived through it, the market was down 57%. That means if you put in $100,000, right? That was one of the worst corrections on record ever. You put in $100,000 in the fourth quarter of 2007. You got 40,000 left at the beginning of 2009. And that's 18 months of straight declines, right? And our job, of course, we don't have a crystal ball. However, we're pretty good at mitigating risk. In other words, losing less than 60% in a downturn means that you've got much more buying power when the market turns around and goes back up. We can use alts, alternative investments. We can use a lot of other investments besides just stocks, which can help to preserve on the way down. I had a client and the one example I'll give you real quickly is I had a client who his wife just said, enough, I can't take it anymore, right? And then remember, the news was very bad, right? So there was no indication that anything was going to turn around. And so I had a client whose wife said, no, stop, no more. I just can't, no more loss. We have to switch into conservative. And we all know what happened. Q1, 2009, market turns around, skyrockets for a decade. Well, we're conservative because, the wife and husband had different values, right? The husband said, I don't know, should we start buying yet? And every time we got on a call, if I had an investment policy statement, I could have said, hey, look, I know we're in a challenging time. I know it doesn't feel like things are going to turn around, but historically, blah, blah, blah. All of the wisdom says we need to start buying. Then we followed the wife's desire not to lose, stayed conservative. And then a few years later, after the market skyrockets a couple of years, they come to me and say, hey, we're missing all these returns. We're gone. Like, sorry, we love you. It's been a great ride, but it didn't work. So that's in a case where I should have had an investment policy statement. It probably would have preserved the relationship.
Thank you for sharing that. And Pat, you had mentioned something earlier. Easiest thing to do is get out of the market. One of the most difficult things for investors to do is, when do you get back in?
Yeah.
And to your point, Brad, I don't want to lose. I'm tired of losing on the way down. And then why haven't you made me enough? I think that my biggest conversation regarding that was 2013, where I had an investor that was tied to the S&P, got S&P-like returns. But then I lost the client which is the same client, because he says, my friend made 50%. We didn't make 50%. Why didn't we make 50%? And I said, well, let's look at your investment policy statement. And there's nowhere there. And to sum that up, what it came back to is, hey, you're my financial advisor. You're supposed to be telling me. And my feedback was, I'm not here to make you rich. I'm here to help you not blow yourself up. And really, that was the crux of the conversation. Because if it were to be opposite, then it would be the same conversation, but you lost me a ton of money. Because what kind of risk did your friend or your buddy take to get that 50% return in 2013 versus 33% on the S&P, right? You have to take a substantial amount more risk to get a 50% return in a very strong year. When the market takes a dump, then your amount of risk that you have on the downside is going to be substantially higher. And then you're going to leave the advisor anyway. Oh, they lost me a ton of money, or you didn't make me enough money. And I think that we've all stopped over our careers working with those types of clients because they're more of a nightmare and they're very stressful because you're never good enough. And it comes back to their behaviors. Well, am I not good enough? Or is there something in their mind that's telling them they're not good enough? I stop worrying about things that are completely out of my control. So, but the investment policy statement works with the majority of our clients. At least that's what, from my experience, so that's what I can say.
You know, an interesting thing too is after a down year or a down 2 years, it's very rare, by the way, that there's 2 years in a row that are down. In fact, during the Great Recession, there was only one down year. 2007 was up a smidge because it didn't start dropping till Q4. 2008 was down, brutal. And then 2009 recovered. So even in the 57% drop, there was really only one down year. But that said, a lot of times when the market starts recovering after a down period, clients look at it and go, I haven't made money. I'm flat over 3 years. Well, look, if we've only lost, say, 20% during the Great Recession when the S&P dropped by 57%, and then we look at 2010, 2011, if you zoom out, it's possible that we outperformed the market over a longer period of time. But when the market's down and we say, hey, we're only down 22 as an example, we were only down 5% and the market was down, the blended rate between the S&P and the NASDAQ was a minus 27. I read an article the other day that said most large cap growth funds were down something like 32% in 2022. If we're down 5 and then we underperform on the upside because we kept you conservative into 2022, most analysts thought 2023 was not going to be as strong on the upside. So we were a little less conservative than the market. And they look at it and go, hey, well, S&P's up 20%. Why aren't we up 20%? Well, let's look at a 2-year period. We annihilated the market over a 2-year period because we lost so much less in 2022. So that's why the investment policy statement is critical. It's important to ground and keep rational when we have those huge swings.
Really, only 2008 was a down year. As you guys heard me say many times, volatility it doesn't stay elevated for an extremely long period of time. Those typically end up turning into really good long-term opportunities. So if you have volatility spikes, they're usually around a headline risk or overall bad earnings in a sector, monetary policy, some kind of announcement, and it's called fading the fear. The VIX is the fear index, right? It doesn't stay high for very long periods of time. So that's one indication that you can talk to clients about and also put that into the investment policy statement. So let's say, for example, if the market's down 20, you're down 5, that's a grand slam in our world. To some people, that might be, the market's crashing, because everybody has a definition of a crash. To us, a crash would be 20%. To some people, a crash is 2%. And to Pat's point earlier, you've always been a saver. Then you got this financial person trying to get you to invest in money. I always tell people if they're taking one step forward and they're going into, let's say, all cash and they're going into like a 20/80 portfolio, I tell them just expect for the market to pull back just because you're investing, just to get some experience with it, because typically that's what happens. It's very rare you put somebody's money in and it goes up over the first week. It usually goes down. So I try to prepare people if they're extremely conservative. If you're taking one step forward, just be prepared for the market the first week, the first month for it to be negative. That doesn't mean it's crashing, but a 2% crash to some people might be a really big deal, where in others, Pat and I have clients before that the market's down 30%. I got people in their 80s and 90s saying, hey, are we going to be buying stocks? Completely different type of investment acumen.
One thing that's tough on folks is that our lives, we think and communicate in pretty much everything other than dollar amount. Percentages, allocation percentages, basis points, all of these things. And let's face it, if we're not finance people, we're thinking in a month's salary, a year's salary. And so if somebody grew up, let's say they were raised by parents of the Depression, let's say that they're in their late 70s, early 80s, and let's say they have a $2 million portfolio and their allocation is down 8%. Okay. That's just a huge amount of dollars to them, because they'll look at that and they go, what we just lost is what my parents paid for their first house in the 60s or in the 50s or whatever it may be. So that could be shocking. It could be horrifying. It could be just absolutely gut wrenching. And another one is like the guy, gal, 40s, 50s, and they go, hey, I've got $500K in my 401k, and I felt really good about that. I could say that I have $500,000 in an investment. That feels sort of neat. I feel like I hit this point on the horizon where I'm actually doing something. And you get into a bad market and their allocation has, let's face it, they've never been changed. They've been 100% equity probably the entire time. And so their $500,000 high watermark goes down to $370,000. First off, I'll tell you this, ladies and folks, we understand how much that hurts. We understand how much that hurts. But when we look at that, we say, okay, well, they're down, what is that, 26%? They're down a certain amount, right? However, we do know that that same amount is going to come back.
Yeah, that's right.
So when that person is looking at their 401k, it's extraordinarily depressing. That's actually a false signal because a 401k may be the definition of the perfect long-term savings vehicle where you're going to put money once or twice a month in for decades. And let's be honest, would you rather buy things on sale or would you rather buy things at an all-time high price? So this is a contraindicator. Well, I want to buy things on sale. Yeah, but I also want my stock portfolio to be extraordinarily high. You don't get both, you get one or the other. And so we see people, because they don't have a solid foundation, they'll say, well, forget it. I can't keep putting money into this 401k. It just hurts so much. And what you do is we kind of pull our hair out and like, go, my God, you're going to be able to make 3 years worth of returns in 9 months if you just keep plowing that money into the market during a massive sell-off. That's when you make your money, not when you feel cute and you're showing your friends and whatever your 401k balance when you're at the top of the market. Kiss of death.
Let's do a podcast on each one of these items. One is people will not look at their 401k for decades. And even going through two of the worst corrections, the tech crash and the Great Recession, and not think about it at all. And then we get an account, we open an account, and they're looking at it monthly. Right? Say, hey, the market's up, the market's down. What's going on? Why am I losing money? And they wouldn't even listen to it. Well, let's take a look at your 401k. You haven't looked at that in 20 years, right? I mean, how do you think the performance there? And say, well, that has nothing to do with this. Oh, and part of it is because they know they're paying us, right? And so that's the other thing is we really want to talk at some point about this fee thing because, yeah, you're paying us. And the difference between us and the mutual fund portfolio you have is that you can see the fee you're paying us. You can't see the fee you're paying into your mutual fund. It's there, even if they're so-called, quote unquote, no loads. You can go over to
which are the most expensive, by the way.
Which are the most expensive. They only have to advertise a certain amount of the fees. There's a big part of that underwater or behind the scenes that they don't have to advertise. You can go over to a tool called personalfund.com, which is a consumer's tool. It's not a financial advisor's tool. We have a bunch of fancy stuff on our end that you will trust or sometimes don't believe. So go to the consumer tool called personalfund.com, put in your symbol, your mutual fund symbol, and they tell you the plain truth and how much you're really paying there. And a lot of times, even with a no load, you're paying more to the mutual fund than you are to us. And think about all of the other service you get from us than you do from a mutual fund with no advisor, no advice, no financial plan, no investment policy statement, etc.
Give it full disclosure. That is not a paid advertisement for personalfund.com, nor are they are we sponsored by them. Full transparency in terms of, you want to do a podcast on those different issues. I think that's a great idea. And the fee thing, for example, I think a good situation would be, I have $10 million in Apple stock. Great. And I want to diversify out. Okay, I'll give you this chunk of money. You're right. The investor tends to, even if it's 1% of that $10 million, they'll keep an eye on that, and they're monitoring you like a micromanager. For example, let's say it's July and the S&P is up 16% for the first 7 months. Come December, let's say from July to December, S&P did 4%. Well, total year, you know what it did. And they'll ask, why didn't we make the full amount of the S&P 500? Well, it's a time-weighted value. You're only invested the last 5 months of the year. First 4 months of the year had 80% returns. I mean, have you ever had that conversation before?
They should be doing it on their own. And everybody's a genius when the market's going up.
Yeah, I wrote a paper about it in published on LinkedIn. Everybody's a genius in a bull market.
Exactly. And so again, this goes into the zoom out. And by the way, this is most relevant to the IPS, the investment policy statement, because when the market drops, when you go through a COVID, when you go through 2022 and we lose less than the market, that's our opportunity to catch up. And I'm not saying we don't compare ourselves to the market because we're probably never going to have you at 100% equities ever. There's no reason to have that much risk, right? And so the long-term over 20-year average of the S&P 500, the thing that everybody compares you to, the market, the financial advisors, is only 6%.
There is one funny thing that you brought to mind is there have been certain markets where the market was down 20% and our portfolios were down 8 or 10. And the hard thing is you look at a portfolio that has $1 million, down 10%, I have $900,000. Again, when people think in dollar terms, wow, that's very difficult. But when the market's down 22 and you're down 10, no one's ever sent me a thank you card.
Never.
No one's ever patted me on the back.
Classic.
This is my daughter. I'd love for you to meet her. Yeah. It's never happened. It's never happened. So anyway, I do like a pat on the back every now and then. But the contra side to that is that let's say we get a tech market, right? Let's say, kind of like now, let's say we have a NASDAQ that's just flying off the handle. And yes, you're going to have components in your portfolio that are going to be directly attributable to the rise in the NASDAQ. And you're also going to have a lot that's directly attributable to, in this case, the Russell 2000 or the Dow, the QQQ, all these different sorts of things. So your blended rate of return is almost always going to be less than a hot market. However, your blended rate of return in many, many, many cases, you're going to, and to say that you're outperforming, hey, I'm down 2%, I'm outperforming, congratulations. A lot of retail investors just don't look at it that way. But for us, it's like, hey, if we can prevent you from taking a big body blow, you're still in the game, and we could buy with some of that cash that you have. Now you're controlling your own destiny to a much higher degree.
I also don't really care for benchmarks. And really, what is the market? When people say, the market, well, which one? There's a lot of different markets. Pick a benchmark, right? I think when growth stocks are hot, the benchmark is the NASDAQ 100. When markets are doing pretty good, it could be the S&P. It's wise to have conversations about a client's individualized benchmark. What's your benchmark? What's the average return that you want to make per year? Okay, great. That's your benchmark then. That's what your goal is. Your objective is to make 7%, 8% year on year over a business cycle, depending on where you are in that business cycle and you start working together. But it takes an entire business cycle for you to experience that average rate of return, not just 1 or 2 really strong years. So I've never been 100% equities. I've never put a client in 100% equities. I just don't find the need to. And quite frankly, again, you don't need to take that much risk to make a good return over the long period of time.
Those downturns, if we can mitigate risk in the downturns, and that's what we're here for. Well, not just that, because the other thing that we do, advisors do, not just us, of course, is, Pat, your example earlier of having $1 million that only dropped 10% instead of 22. When someone's got $1 million that drops to 900, you know what they're going to do without an advisor? They're going to sell. Grab the investment policy statement. Look, you're only down 10, the market's down 22. Not only should you not sell, let's start adding some money like you did in your 401k and look at those astounding results. Getting back to the original conversation, which is the IPS, it's really a solid foundation to keep people invested when they don't want to be, and to keep them from being greedy when they want to get overly aggressive when they don't need to be.
Yeah. And you got to figure our experience. How many times have we had this conversation? How many times have we experienced this over a very long period of time? So it's not like it's our first rodeo. This is something we've been doing for decades. So we're very comfortable having these conversations. And we understand that it might be somebody's very first time dealing with a bull market and a bear market. Because even though it's a bull market and things are great, knowing how to handle those types of gains is not easy in itself, because then the greed factor kicks in. And then in a bear market, I typically use investors' emotions as a gauge. Are we near a bottom? That one client that never calls or wants to talk with you once a year, when they call you, then you're like, okay, my phone rings. I'm like, oh, okay, then it's probably, they'll call me back 6 months later. It's probably close to a bear market. I can imagine what the phone calls are going to be about. And it's just them expressing their concern and walk them through it. But then next thing you know, the market starts to turn around over the next 2 or 3 weeks. And again, it's that experience dealing with these types of emotions on a regular basis, because I'm going to say that I have conversations about economy and the market almost daily. So it's not something that is a surprise to us. We've seen almost everything under the sun when it comes to greed, when it comes to fear, and everything else in between.
Yeah. I mean, 25 years in the business, we've seen it all. We've seen fear, greed, massive corrections. Those of us who lived through the 2000, the dot-com crash saw fortunes annihilated. And companies that nobody suspected were going to just disappeared. I'm not saying that's going to happen again, but that experience helps us keep people aligned with their goals.
If I retired tomorrow, there's no way I'm going to do this on my own. There's no way. Even with 20 plus years of experience, there's no way I'm doing this on my own. The tectonic plates of the global economy are shifting under our feet, and we have to listen to many conference calls. We have to read a ton, and we have to be talking to a lot of the right people to figure out how do we position things. The way that we may position things may seem small, only moving 5% from out of this and into this. Then the next year, 7% out of this into this. These don't seem like huge shifts, but these are trim tabs. They're small adjustments that you make. I remember talking to my godfather, my uncle, my dad. This is in 2009. And they were basically saying, we haven't seen anything like this. And they've been doing this stuff since the 60s. And those of us that kept our head were able to buy when the rest of the world was being forced to liquidate. Right, there's a scary thing. You're forced to liquidate. And that was from, every different financial asset that you can possibly think of. The only thing that made money was cash or maybe derivatives. I don't know. But these things are just absolutely terrifying. And the people who took our advice, and again, I'll be honest and say that I was sitting in my car out in front of my gym thinking, is our banking system really going to collapse? And I sat there for about 25 minutes and I'm thinking, there's no way the government's going to let it do that. There's no way. They're not going to let the goose that makes all those golden eggs, they're not going to let that go away. Now, that was my guess and it worked out. But that was the one time in the last few decades where I was absolutely the most in doubt. When the planes hit the towers, when COVID happened, when all of these other exogenous shocks to the system happen, we all have this real fantasy part of our brains, which says, okay, I've seen all the movies, cue the zombies, we're all going, this whole thing's going to melt down and go to zero. We've seen all these movies. But if you just keep your head and stay invested, what was the one thing at Costco that an absolute run was made on that product? Do you guys remember what it was?
No.
Toilet paper
and paper towels. Well, I think first toilet paper and then the shoulders
hand
were shrugged and hand
sanitizer
cleaned out as well. But there are so many necessary things that are needed out there. And even when the stock market is getting crushed, there were lots of companies out there whose balance sheets were so bulletproof that they just continued to go on and do business as usual. Their stock prices didn't look real good. They were actually great values, but their companies continued to do very, very well. And it seems like we're saying the same song over and over and over, but thank God it's the same song and not a different song. What if it was, well, hey, I don't know, our sovereign debt's going to go bankrupt. That's the new crisis du jour, right? Hey, now that our spending is now higher than our GDP. A lot of these things are manufactured stories. Personally, I don't think that one's manufactured. I think it's true. But guess what? We've seen ourselves get out of worse. If you are a believer in the United States, if you're a believer that there is no free lunch and that volatility is the price we have to pay in order to get the financial outcomes that we want, you'll do well. Those are my 3 tenets that I'm sticking with.
And as you said, if you were to do it on your own right now, I think that the markets are too dynamic for someone to just, I'm going to retire, I'm going to take my finger off the pulse. And there's too much information flowing around at a rapid speed. And unless you have your finger on the pulse, I think you can get yourself into trouble really quick, because it's not the type of market that your parents, my parents, or Brad's parents grew up in, where you can set it and forget it, which that's the same thing as giving up, which is the same thing as indexing, which quite frankly is giving up. But I just don't think it's a good idea to set it and forget it in this type of market.
Totally agree. And these are all some great topics that we will cover. It's critical, taxes. Listen, when we're rebalancing because we're selling high, there's going to be some taxes. There's going to be some taxes to pay, and that's always conversation. And fees. Why do you pay the fees, et cetera? So I look forward to educating and talking about these topics so that hopefully we can make it understandable to people so that they can come to us or do a better job of however they're already doing it.
Yeah, and in summing this whole thing up, the investment policy statement focuses on specifics of investment management, and a financial plan addresses a broader spectrum of financial matters. And together they act as a roadmap for investors. We thank you guys for tuning in, and until next time, have a good day.
Thanks for listening to the Sage Planning Solutions Podcast. Be sure to subscribe so you don't miss the next episode. If you want more information, visit our website at sageplanningsolutions.com.